So in chapter number 2 is about balance sheet and various aspects of balance sheet. So what we have studied so far in our financial accounting, that balance sheet is basically a financial statement that gives a financial position of a company at a point in time, most likely end of the year, December 31st, say 2020. And balance sheet has three major parts: assets, liabilities, and equity. So now we're going to go a little bit more in detail to see these things, and we're also going to talk about other kinds of assets and purchase and disposition of assets. And also, because assets, it's something, not all, but most of the assets gets depreciated, so we're going to talk about a little bit about depreciation, various aspects of depreciation. So in this video we are going to talk about balance sheet and the asset part. All right, so as I said, balance sheet gives you the financial position, and it talks about assets, liability, and equity. It consists of permanent account, as I said in my previous lecture as well, that income statement accounts, revenue and expense are temporary account, because those accounts gets closed into a statement of retained earning. But balance sheet accounts are permanent account, and permanent accounts has a beginning balance and ending balance. So that's why the beginning ending balance of a balance sheet becomes the next date on January 1st at the beginning balance of the year. So the ending balance of 2020 will become the ending balance of 2021. So we're going to talk about what are the useful part of the balance sheet are, and if there is any limitation with balance sheet. So balance sheet summarize the economic resources and obligation. What does it mean by resources and application? Resources are our assets, means something that is going to provide you a future benefit. Obligation is something that we owe as a business to another party, and that impacts entity's ability to generate future cash flow. So how much debt you have, how much assets you have is going to it's going to tell us about how much the business is going to generate cash. Second point, it is useful in assessing an entity's rate of return on its investment. So where do you invest? We talked about in the chapter number 1, we investing activities, or we invest in the business by building factories, by building shops, by purchasing assets that's going to help us run our business. So we want to know the investments that we are making, what kind of return we are receiving for those investments. It also helps in assessing risk associated with an entity by providing inputs for cash flow measures. So basically this also helps us calculate the statement of cash flow, in which how much cash is coming from or going into operations, so how much cash is generated through investing activities, or how much cash went out, which is outflow, and how much cash inflow was through financing activities, and how much cash outflow through financing activities. So the limitations of balance sheet: many of the accounts on balance sheet are reported at historical cost. Remember, I said in the chapter number 1 video that when you are purchasing a building, say for $50,000, you always going to report that building at $50,000, even though the market value of the building is constantly at rise. So suppose after 10 years, the market value of the building is now $500,000, but you would leave the building in the balance sheet at $50,000. So that's one thing. So we always report the assets and the liabilities at the historical cost in the balance sheet. So that change the perspective a little bit. A number of assets and liabilities are not recorded on the balance sheets. For example, human resource. I'm talking about the employees that are working, that they are an asset for a company, but they are not recorded on the balance sheet of a company. For example, if there is a new company and there are scientists working, developing new products, those scientists are not part of the assets. Many of the accounts reported on the balance sheet are based on estimates as opposed to determinable value. So like we talked about account receivable. So for example, a company has claims on customers for $50,000. But if a company thinks that 10% of those account receivable are not going to be recouped, means that's an estimate that the 5,000 we may or may not receive. We may not receive more than 5,000, or we may receive less than 5,000. So that's the issue, that there are estimates in the balance sheet. So these are the limitation when you are analyzing the balance sheet you should keep in mind. Balance sheet classifications. Sub-classification enhance the usefulness of the balance sheet by grouping the accounts according to characteristics such as nature, function, or size. So as we already know, we decided to divide the balance sheet between assets, liabilities, and equity accounts. And then we further divide the assets among current assets and long-term assets, and the liabilities among current liabilities and long-term liabilities. Current assets has a life of less than 1 year. Long-term asset has a life greater than 1 year. Current liabilities has a life of less than 1 year, and long-term liabilities has a life greater than 1 year. So that's what we need to get. So one of the primary distinction is the current versus non-current. Current asset, as I said, so non-current sometimes are called long-term. So don't get confused. The long-term liabilities or long-term assets or non-current assets or non-current liabilities are the same things. Manager have several reporting options for the balance sheet, including the following: aggregating and summarizing accounts into financial statement components or line items. Grouping, again, the current assets versus the long-term assets. Assets and liabilities can be grouped or classified as current and non-current. We already talked about. Providing the subtotal. So for example, under assets, you have current assets, and then you have total current assets, and then you have long-term assets, and then you have total long-term assets, and then there is a total of total assets. So you can do that this way as well. So how much total current assets you have, and how much total current long-term assets you have. Again, assets are generally subdivided as current assets and long-term assets. So long-term assets are long-term investment, property, plant, and equipment, intangible assets, and other assets. Current asset, as we know, is always cash, account receivable, inventory, prepaid, short-term investments. So we're going to further discuss in this current assets are cash includes coin, currency, money orders, traveler's checks. We don't use it much, but traveler checks was another thing. And short-term, highly liquid investments such as T-bills. So T-bills are also considered, but keep in mind is 3 months or less. So that anything that can be converted very, very quickly into cash is considered cash equivalent. And anything that could be converted, so just keep in a rule of thumb, it's 90 days. Cash influence, other includes commercial papers, money market funds, and US Treasury bills. The T-bills and Treasury bills are the same thing. Short-term investments, it could be in debt or equity. Equity simply means stocks, and debt simply means bonds or notes payable. So it could be any of these. Usually these things are very easy to trade. That's why they are considered short-term. Consider this thing as like day trading, most people do. Account receivable, also called trade receivable. So please do not get confused. Trade receivables, account receivable, same thing. This is the amount your customer owes to the business because you either provide them a product or the service. Inventory is a tangible. It's either held for sale in ordinary course of business. So for example, if you go to Best Buy, all the inventory that you see in their store or, behind the store is the inventory that is available for sale at any point when customer make the purchase. So that is considered ordinary course of business. So inventory is, let me give you, there are three. So they are raw material inventory, work in process inventory, and finished goods. So when I'm talking about Best Buy is selling a finished good, whether it's a TV, it's a fridge, washer and dryer, anything is finished, ready to be used. Work in process inventory is usually manufacturing companies at the end of the year tell you how many incomplete items. So for example, Ford Motor Company producing F-150 trucks. So how many F-150 trucks are still on the assembly line? They may be 50% complete, 60% complete. So that's what's called work in process. Anything work in raw material. Raw material is an inventory that is held in a warehouse to be used on the assembly line to produce products. So for example, Ford Motor Company keeps a lot of raw materials such as tires, seats, steering wheels, mirrors, batteries as raw material. Okay. Prepaid expenses are the assets. They are called expense, but they're asset because you have paid in advance. For example, I pay my auto insurance 6 months in advance. So I'm going to pay next month my insurance for the next 6 months. So on the day of payment, I have give them say $600 for my car for 6 months. So at the end of the month, I have used only 100. So after 1 month, I still have $500 to go. So that $500 is my asset. The $100 that I have already used would be considered insurance expense. So that's the include prepaid rent, prepaid insurance, and office supplies. Long-term investments, and it could be in debt, again, it could be equity, and investment in land and other property that are not used in operation. So anything, for example, a Ford Motor Company wants to open a new factory sometimes in the next 5 years in Fort Worth, Texas, and they purchase 50 acres of land, but that land is not getting used in day-to-day operation. So that's why this land would be considered a long-term investment because it will be used 5 years from today. And we do not know whether they're going to open a factory or not. It's just a plan. So it is considered a long-term asset. So you're going to hear this word a lot, property, plant, and equipment. It is also called PP&E. So what does it mean? It simply means a factory. Factory has a land, then factory has a building. The building, so they have a land. On that land, they build the building, and inside the building, they have equipment and machines. So that property and plant and equipment basically talks about a factory. So they are tangible, long-lived asset and used in the production. So for example, a Ford Motor Company, I believe they have a F-150 truck production facility here in Fort Worth. So that factory is their PP&E because they are producing F-150 truck. Whether they are assembling it or whether they are producing is the same thing here. Examples, they are giving you property, plant, equipment, buildings, land, machinery, equipment, office furniture, office equipment. I didn't put it's called office equipment such as, big copier machines, big printer machines, things like that. And natural resources as well. When we're talking about natural resources, let's consider oil and gas. Also consider metals, precious metals. These are natural resources. And all property is reported on the balance sheet net of accumulated depreciation or depletion except of land. So let's talk about all long-term assets except land. I would say never depreciates. So if you have this question shows up in the exam, land never depreciates. Okay. Tangible assets like the one that we can touch and feel, such as building, a tangible assets depreciates. Okay. Natural resources, what we call depletion, means when you purchase an oil and gas well, a geologist will tell you how much oil you can extract from it. Suppose 20 million barrel oil that could come from. So after 10 or 5 years down the road, you have depleted or you extracted all the oil out of it. So you have depleted, so that's why it's called depletion. Intangible assets such as trademark, copyright, franchise, these are called intangible assets. And these intangible assets, basically what we do, we amortize. So amortize. So amortization, depreciation, they are our similar method. Basically what we are saying that we have used part of the asset, and since we use the part of the asset, it has now become an expense. So we are removing a part that has been used and putting it into an income statement as an expense. Why? Because we use this asset to generate a revenue, and we always have to match revenue with our expense, the matching principle we talked about in chapter number 1. Intangible assets, they do not have physical, you cannot touch them. What are those intangible assets? We are trademarks, trade names, broadcast license, patents, copyright, and franchises. These are basically intangible assets, and we are going to amortize those assets. The other asset category include any non-current asset that does not fall into any of the primary balance sheet classification. For example, long-term prepaid expenses and land held for resale may be classified as another. So if you have a land that you have classified that you are going to sell, it will be part of your other asset. Or if you have long-term prepaid expense, such as, for example, you rent a warehouse for 5 years and you paid the 5-year worth of rent in advance, so that will be considered a other assets. So we're gonna stop here at this point, and will continue our discussion in the next episode or next video for liabilities.